We're jumping straight into Eos Energy Enterprises today. Everyone's watching the price action, but the real story is their pivot to AI data centers and the massive bet on zinc technology.
It really is.
You see that chart, right?
Yeah.
An 18, almost 19% gain after their big event.
Yep, the Eos in Focus event.
And it's so tempting to just, stop there,
Yeah.
say, okay, momentum play. But there's this huge conflict brewing under the surface.
It really is.
Is this a company that's going to hit, what, $1.4 billion in revenue by 2028? Or is all this cash burn, all the insiders selling, just a giant red flag we're all ignoring?
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And hey, before we get into the weeds of zinc versus lithium and why that chemistry really matters for your portfolio, do me a huge favor. Subscribe, hit the like button.
It really helps us out.
It keeps the lights on and it keeps you ahead of the curve.
So let's set the stage a little. Eos Energy. It's a name that pops up a lot in, the whole green transition space. But I think people kind of misunderstand what they actually do.
Right. This isn't about car batteries.
Not at all. They're not competing with Tesla for your driveway. This is stationary storage.
Big boxes.
Yeah.
Big boxes that hold power. But the tech, it gets complex fast. I'm looking at notes on Znyth technology and zinc halides.
Yeah.
It sounds like a chemistry final.
It can, yeah.
But the investment thesis is actually pretty simple, isn't it? It just comes down to execution and, cash flow. Can they build the stuff and can they afford to?
That's the whole ballgame. It's a race against time. They might have a better mousetrap, or at least a safer one, but they have to scale it up before the money runs out. It's the classic startup problem.
Just on a massive industrial scale.
Exactly.
Okay, let's start with the bull case, because the numbers they're throwing around, honestly, they're pretty aggressive. They just confirmed their 2025 guidance.
Yep, full year 2025. $150 to $160 million in revenue.
Which is solid for a growth company. But then they dropped the 2028 projection, $1.4 billion.
It's a massive jump. You're talking about almost a 10x in just 3 years.
Exactly. And my skepticism radar just goes off. Is this based on hope, or is there a real mechanism behind that number?
It's a fair question, and the mechanism is their manufacturing expansion.
Yeah.
Specifically, their new Z3 modules. They're not just hoping the market grows for them.
They're banking on this new module becoming the standard.
Right. The Z3 is all about automated mass production. Think of it like a modern car assembly line versus building one by hand. If they get that automation humming, that 1.4 billion number starts to look, well, at least plausible.
It's an execution play, pure and simple.
Totally.
Which brings us to the moat. What protects them? For Eos, it's the chemistry. It's zinc. So why should an investor care about zinc? Lithium is king, right? It's in everything.
It is, but lithium has a big problem, a really big problem, safety.
You mean the fires?
The fires. Lithium-ion batteries can go into what's called thermal runaway. They basically create their own oxygen and burn in a way you can't easily put out.
Which is why you can't just stick them in the basement of a skyscraper.
Exactly. The fire codes are a nightmare. You need huge spacing, concrete bunkers, expensive suppression systems. It's an insurance and logistics headache.
Okay, so how is Eos different?
Their Znyth technology is a zinc halide chemistry. The key part is that the electrolyte is water-based. It's non-flammable. You could literally shoot a bullet through it and it won't explode.
So for an investor, non-flammable equals more money because why?
Because of siting. That's the industry term.
Yeah.
You can put these zinc batteries in places lithium can't go, dense urban areas. You can pack them right next to each other.
Which saves on land.
A ton of money on land. And that leads right into their new product, the Indensity system.
I love the name. Sounds like a Jason Bourne movie.
It's good branding, but the tech is real. They're targeting 1 gigawatt hour per acre.
And that's a lot.
That is incredibly dense. And density matters because real estate near data centers or substations is crazy expensive. Eos can say, hey, we'll fit double the storage in the same space as the lithium guys. That's a huge selling point.
And they're pointing this squarely at AI. This is the part that I think really got the market excited, the AI connection.
The AI narrative is everything right now. Without it, Eos is just another interesting battery company.
Right.
With it, they're an infrastructure play on the biggest trend in tech.
We all know AI uses a ton of power. These data centers are just energy hogs. But why Eos? Why not just buy more Tesla megapacks? They work.
It comes down to 2 words: discharge duration.
Okay, break that down.
Lithium is a sprinter. It's good for a quick burst of power, maybe 2 to 4 hours, great for handling a short peak in demand.
But AI data centers don't just have a peak. They run all day, all night.
Exactly. They have a continuous heavy baseload. They need power for 4, 8, 12, even 16 hours straight. They need a marathon runner, not a sprinter.
And trying to make lithium run a marathon gets really expensive.
Yeah. It becomes economically unviable. You have to stack so many of them. EOS's zinc tech is designed for that 3 to 12-hour duration. That's its sweet spot.
It's a perfect fit for the problem. The picks and shovels play for the AI gold rush.
Precisely. And they're pitching this Eos density with spatial intelligence. It's basically a smart, dense system tailor-made for the AI boom.
And Wall Street is clearly starting to believe it. That financing news was huge. Over $850 million.
That was the lifeline. Securing that capital, a lot of it backed by the Department of Energy, is what lets them actually build the factories. You can't make $1.4 billion in revenue from a lab.
And you can feel the sentiment shifting. I was looking at the short interest data.
It's dropped, right?
Yeah, down about 10%. It's sitting around 27% now.
Which is still really high, let's be clear. A quarter of the market is betting against it.
Yeah.
But a 10% drop means some of the bears are getting nervous and closing their positions.
Okay, so that's the bull case. Safe zinc tech, a perfect fit for AI, and the cash to build it. But let's look at the flip side. You don't get this kind of potential reward without some serious risk.
Oh, absolutely not. And the risks here they're not subtle. They are glaring.
Let's start with the balance sheet. That last earnings report was rough.
It was a huge miss, a massive earnings per share miss. They lost, what, $2.77 per share when the street expected a loss of 31 cents.
Which means they're burning cash way, way faster than anyone thought.
It's the cost of scaling. When you're trying to ramp up manufacturing like this, your efficiency is terrible at first. You're paying for all the equipment and people, but you're not shipping enough product to cover those costs yet.
And even with that $850 million in financing, they've also proposed another $500 million capital raise.
And this is where we get to dilution. It makes existing investors very nervous.
So for anyone listening, dilution means they're basically selling more stock to raise cash. Your slice of the company pie gets smaller.
That's the perfect analogy. The company needs the money to grow, but getting that money hurts the people who already own the stock. It's a necessary evil for a company like this, but it's painful.
Right. And speaking of selling stock, this is the red flag that really jumped out at me. The insiders.
Yeah.
What are the executives doing?
They're selling. The CEO over the last year has sold about $1.9 million worth of stock.
And his purchases.
0. No open market buys.
See, that's the thing that gives me pause. If you genuinely believe your company is about to 10x its revenue and power the AI revolution, why are you selling almost $2 million in stock? Why aren't you buying?
It's the big question. Now, to be fair, executives sell for lots of reasons. Taxes, buying a house, who knows? But the lack of buying is the real signal.
Selling can be explained away. Buying only happens for one reason.
You think the stock is going up, and the lack of buying suggests they know the road ahead is going to be bumpy, even if they believe in the long-term story.
Actions speak louder than slide decks. And that brings us to the execution hurdles themselves. Manufacturing is it's hard.
It's hell, and they're trying to scale a brand new technology in the U.S. This isn't like you can just order standard battery-making machines from China. They're inventing the process as they go.
So every little hiccup, every machine that breaks is a major problem.
It's a high-wire act. They have to manage a new supply chain, scale production, all while their cash is burning. One bad quarter, one production stall, and they could be in real trouble.
And the analysts seem to see that. The consensus is kind of sitting on the fence. The average price target is what, around $12?
Yeah, $12.44. It's the market saying, cool story, we love the AI angle, now show us you can actually build it and sell it. Show us the money.
So for everyone listening, what should we be watching over the next, say, 30 to 90 days? What are the key things to look for?
Well, earnings, obviously. We don't have a date for Q1 2026 yet, but when it drops, look past the headline numbers. Look for 2 things. 1, do they reiterate that 2025 guidance? And 2, and this is more important, are they reporting any actual traction for the in-density product?
You mean signed contracts?
Signed contracts, not interest or pipeline. I want to see a press release saying they signed a pilot program with a major data center operator or a utility. That's the validation the market needs.
And there's another thing for traders to watch now, right? This new ETF.
Oh, yeah. The TRX2X Long EOS Daily Target ETF, ticker is EOSU.
So for anyone unfamiliar, this is a leveraged fund. If the stock goes up 1%, this thing is designed to go up 2%, and vice versa.
Exactly. It just adds fuel to the fire, both ways. The existence of this ETF means you can expect much bigger, sharper swings in the stock price. It attracts a lot of fast money.
So buckle up. And on the macro side,
Keep an eye on the news cycle about data center power constraints. Any headline about, say, Northern Virginia running out of grid capacity,
which is actually happening.
which is happening, that's a direct catalyst for EOS. The worse the grid problems get, the stronger their value proposition becomes.
And I assume we should watch politics too. Supply chain policy.
Huge. EOS is a made-in-America story. They build in Pennsylvania. Any policy that favors domestic manufacturing or puts tariffs on Chinese lithium batteries is a direct tailwind for them.
Okay, let's wrap this up. The lowdown. You've got the bull case, this incredible zinc tech that's safer, denser, and perfect for the AI boom, and they've got the cash to build it.
A very compelling story.
Then you've got the bear case, an ugly balance sheet, massive cash burn, dilution risk, and a CEO who is selling, not buying.
It's a classic high-risk, high-reward play. You're betting on the technology winning, but you're also betting against the balance sheet dragging them under first.
So here's the final thought I want to leave you with. The company's whole story right now is built around the Indensity launch, this breakthrough product that will power the AI revolution. But if it's truly that big a deal, if it is the key to a billion-dollar future, why is the CEO selling $1.9 million worth of stock instead of buying more? That is the question you need to answer before you place your order.
It's the million-dollar question. Literally.
Thanks for tuning in to the Easy Money Show. We'll be tracking this one closely, so make sure you subscribe for the next breakdown. See you next time.